Hello traders, welcome to Investoo.com's Crude Oil Trading 101. In this lesson, we are going to learn what drives crude oil prices. And of course, what drives crude oil prices is an imbalance between buyers and sellers, an imbalance between supply and demand. But we are going to go one step forward, or one step even deeper, and look for what drives that imbalance in the crude oil market. Now we're going to go to this news. All right, this was on the December 4th, 2015 OPEC meeting. For all of you that don't know what OPEC is, well, the OPEC is the cartel that dictates the oil production of course, the OPEC country members. And the members of the OPEC, or the producer members of the OPEC, are basically the largest oil producers in the world, which means that when the OPEC decides about an output, it decides about the global output on crude oil. And on December 4th, 2015, there was a meeting on which they will decide about its production policy. And the decision was not to cut the output of crude oil. This means that there was no ceiling on how much oil can be produced or can be drilled out of the wells from the country members, which meant that the market was going to be oversupplied with the commodity. This means that the more supply there is for the same demand, the cheaper the commodity gets. So, you have to be very careful when you're trading around OPEC news, because that is what drives price, okay? And not immediately. Of course, it drives it immediately. There was a 3 or 4% drop in crude oil, as I'm going to show you right now. But after that, remember that the policy remains until the next OPEC meeting, which means that there was not going to be any ceiling or any production ceiling until the next meeting. And there was no given reason to think that on the next meeting they will agree on an output or on a ceiling. Okay, so crude oil prices were going to be dropping. So let's go to the chart and let's see how crude oil reacted. Now, we said that we wanted to go to December. That's December 15th. Oh, the 4th was a Friday. So let's jump on the 50-minute chart. And here we are on December 4th, 2015, on the 4-hour chart. Now let's zoom in and let's see what happened here. And as you can see, we were trading inside of a range, very choppy range. Even though we were in a down move, we were not in such a strong down move as the one we were after the decision. Now we were trading around the 42 level, and as you can see, this blue vertical line shows the point of the decision. And you can see that oil dropped almost $2 at the time of the decision. And what happens then? Well, what happens then is this. Okay, crude oil traded from the 40 level to a low of around $26 for a 15 to well for a 15 point drop, or a 1,500 tick drop. And what happens after this OPEC meeting and the decision not to cut the output on oil production worldwide? Well, price continued to drop, and then it continued to have release rallies, and then it continued to drop, and then it continued to have retracement, and then it continued to drop even deeper. Okay, so after a decision not to cut the output on production, you are going to look to short the market. not at the same time. Well, you can do it at the same time of the news that is coming out, but by the time the news comes out, the market is already very volatile and you can get burned. So my advice is to wait for the decision, to look for a retracement, and then to go short if the decision is to not to cut the output of production. If we have a decision to cut the output of production, this means that the market is not going to be oversupplied, which means that with the same demand of crude worldwide and less crude oil to offer that demand, price is going to start to move up. And basically, this is how you need to understand crude oil prices and what your research needs to be in order for you to be trading the good side of the market.